Hello, everyone, and welcome to the Edelweiss Wealth Management Conference. I thank you for being part of our flagship Edelweiss Emerging Ideas Conference. It's my pleasure to be host today for the event. 2020, we all know it's been a crazy year for all of us. It's been a lot of learning for all of us. It has opened up the ways to work, to think, to rethink, and to live differently. Today, in our session, we're going to hear insights which will change our perspective forever in terms of portfolio management. Please allow me to welcome Mr. Julius. He has a very interesting background. He graduated from the Dutch Royal Military Academy way back in 1986. In 1990, he left the Air Force as a captain and entered the financial industry as a portfolio manager. Since then, Julius has been working in various capacities and has managed various investment funds. During his stint in various organizations, he has co-authored different asset allocation strategies that have been successfully implemented in discretionary managed accounts. From 2014, he started Rrg Research to solely focus on the promotion and the growth of relative rotation graphs, primarily through partnerships with various data professionals and software professionals to make Rrg available to a wider audience and provide relative-based research to professional investors and entities. Rrg Research is based in Amsterdam, the Netherlands. The topic for today in our session is building portfolios using a rotation model, and that is what we'll discuss today. Sector rotation is a buzzword in finance industry, and from ages we have been trying to understand which sector to buy, and trust me, after this session it will be an enlightenment for all of us to know how to generate alpha, which sectors to look at, the weaker and the stronger ones. So let me not take more time and introduce you the person who is not only the creator of relative rotation graphs, but also a member of CMT and a senior analyst at Stock Charts. Over to you, Mr. Julius.
So Sandeep, thank you very much for that introduction. When I heard you say that I graduated from the military academy in 1987, that all of a sudden made me feel very old. But I guess that's what we all have to go through. Very pleased to be able to present Rrg for an Indian community. Again, I have to say, because last year in November, I was actually with the CMT Association in Mumbai for their summit. So I'm very pleased to be able to be back this year, albeit in a virtual capacity. So we're going to talk about RRGs, about relative rotation graphs, and more specifically in how you can use that tool to build an investment portfolio. Now, I do realize that maybe not everybody knows what an RRG is. So we're going to go to some basic introduction and then try to build that into a portfolio construction tool. So it's always a good idea to start with a definition. And the definition that I came up with for RRGs is that it is a relative rotation graph shows you trends in relative strength or performance of multiple securities in a universe against a common benchmark and against each other. Now, be careful, they don't show relative strength or relative performance as such. It's very important to keep in the back of your mind that we're looking at trends in relative performance. Makes all the difference. We're going to talk a lot more about this, but what you're looking at here, if you've never seen them, this is what an RRG looks like. And don't be afraid, they may seem confusing at the start, but once I explain to you what you're looking at, it will become a lot more clear and intuitive. And if we're building portfolios, and in my view, building a portfolio is basically a whole chain of decisions that a portfolio manager needs to make. And it all starts at the top, where you basically have a big bag of money. And whether that is your own portfolio, whether that is your employer's pension fund, whether that's an investment fund, an asset management company, doesn't really matter. Everybody at some stage starts with a big bag of money. And then the game begins, because you need to decide For example, are you going to invest in bonds or in equities, in stocks? And if you have made that decision, are you going to invest in American bonds, European or Asian, or for equities the same? Will you move to American stock markets, to European stock markets, to Asian stock markets? So you got this whole decision tree that's building, and you know, start simple. It will become difficult very, very rapidly and very complicated, because our investment world is very, very complicated, and we've got a lot of things that we need to look at. So when you talk about taking decisions in the financial markets, and especially at a portfolio level, it is almost always a relative game. You have to decide one or the other. Are we going for stocks or for bonds? Are we going for the IT sector, or are we going for the automobile sector? Are we going for this stock in the IT sector or the other stock? So it's always, you're always comparing things. And we're doing that with what we call the basic instrument is relative strength, and that's the chart that you see below the graph here. By the way, this is the India IT sector, and this is the relative strength of the IT sector versus the Nifty 500. And you can see that just like you see trends in the price graph, you see trends in relative strength, and they go sideways, they go down, they go up. And the interpretation is very simple. If the line here goes up, it means that the IT sector is outperforming the Nifty 500. If the line goes down, it means that the IT sector is underperforming the Nifty 500. And if the line goes sideways, it's moving in line with the Nifty 500. So that's a very important information for a portfolio manager when putting together the portfolio. Now, the problem is that this is always a one-on-one comparison. You can do this only with one sector versus the market, or one sector versus another, or a stock versus a sector, or stocks versus bonds, but it's always a one-on-one comparison. Now, there have been many, many people who have tried to visualize that, that relationship. And the chart that we have on the screen right now is one that many people use, and it's basically a 12-month period anchored back and showing the performances of all these sectors. I call this a spaghetti chart because I find it very difficult to actually pick out the ones that have been doing really well and not so well. The problem is that you can only do it over this fixed time period. But if you have a different starting point, for example, the green one here, and that's the automobile index. By the way, this chart is about a year old, but it's just to give you an idea. But you can see that over the whole period of the chart, that green one was still underwater, was still underperforming the market. But if we would have started somewhere here, you can see that automobiles actually did very well, and they probably did better than the black one here, which was the finance index over that time. So over that whole period, finance was very good, but automobiles was not so good. Would we have started somewhere here, then automobiles would have been much better than finance. And that's what I try to do. I try to pick up those trends in a timely fashion and not just look back 12 months or 6 months or what have you. And it becomes difficult. Picking up individual trends on a chart like this is, well, I think it's difficult. I mean, I hope you agree with me. So that's what we just said. It's difficult to pick that up. Now, one thing that I wanna show you, it's relative rotation graphs and building portfolio is all about universes. You are going to pick from a number of asset classes. You are going to pick from a number of sectors. You're going to pick from individual stocks within those sectors. Now, let's assume that we have 10 sectors, and these are the ticker symbols for the American 10 sectors, GICS level 1, but you can translate that to the Indian markets as easily. And it basically means that you have 100 combinations. So it's 10 times 10. So there's 100 blue squares on the screen. Now, obviously, energy versus energy, you don't have to look at, because that's a straight line. And similar for technology versus technology. You don't need to analyze that relationship because it's one. So we can actually skip the number of elements in that universe. So 10 times 10 is 100, but we can subtract the 10 elements in the universe. That leaves us with 90 possible combinations within this universe. Now, if you've analyzed financials versus technology, you will also have seen technology versus financials, because that's the reverse of that relationship. And the same for energy versus utilities. You've also seen utilities versus energy. So out of that 90 combinations, we can actually drop the bottom half, because they are the reverse of what we see here. So that still leaves us with 45 possible combinations, which is quite a bit. And if you would make that that mathematics, then if you work with 10 sectors, you have 100 minus 10 equals 90 divided by 2 is 45 combinations. If you have 16 industry groups, actually means that you got 256 combinations. Minus 16 is 240 divided by 2 is 120 graphs. Now, if we were in a room, I would have asked you, anyone know how many combinations there are for the Nifty 50? So that's only the Nifty 50, not the 500. And you probably would have answered me, that is 50 times 50 is 2,500, minus 50, 2,450, divided by 2 is 1,225. So imagine, just put it in your head. If you properly want to analyze all 50 stocks in the Nifty 50, you would need to look at 1,225 individual charts. Almost impossible. And even if you would be willing to do that work and flip through 1,225 charts, it'd be very difficult to make sense of that in your head, because you look at it and you're like, oh, chart number 15 looks nice, and 35 is also good, and oh, here is 43, that looks good, and 175. And that, in the end, you would have lost track of what is good and what is bad. And that's where Rrg, and Sandeep already mentioned my military background. With the classic concepts that we have in relative strength, it's very difficult to actually keep an eye on everything, to keep an eye on that broad context. And I've borrowed from my military background. There is a situation that military people always want to have what's called situational awareness. You need to know what's going on around you. It doesn't really matter whether you're flying a jet. Then you have a big AWACS plane that's flying overhead, and they will tell you where your colleagues are, your friends are, and they'll tell you where your enemies are, and they'll direct you to those targets. And if you're in infantry, then infantry units have something that's called Overwatch, and that's the image that you see in the background. Overwatch units are small teams with snipers and binoculars, and they will keep an eye on the battlefield from preferably an elevated position to actually guide the units on the ground to find where they need to battle. And I try to translate that, for example, to sectors. You got an Rrg that is giving you the high-level overview, and it will tell you which sectors you need to battle and where you need to run and where you need to attack. And so in that sense, an Rrg gives you the big picture in one picture. And I think coming from a portfolio background, and if you want to go and build portfolios, it's super important to keep that in the back of your mind. Ultimately, it comes down to selecting individual stocks, but where you find those stocks, in which sectors and regions, etc., for that, you need a big picture overview to make the right decisions. And this is the Rrg showing the Nifty 50. So basically, this Rrg captures 1,225 relations in one chart. And if we go into the building blocks of that chart, then there are essentially two two metrics that are important. And the one is called the JDK-RS ratio, and the second one is the JDK-RS momentum. Now, the RS ratio is the most important one of the two. What it does, it measures trends in relative strength, and it measures the trend strength. So high values are good and low values are bad. Now, the RS momentum metric measures the rate of change, measures the power behind that trend. And because rate of change is a leading indicator, we can use that to our advantage. Because, and I always try to explain momentum as if you throw a ball up in the air, in the beginning, it's got a lot of speed, and the higher it comes, the slower the speed comes. It still goes up, but at a less powerful rate, until it comes to a full standstill, and then starts to move down. In the beginning, the speed will be not so high, and then when it comes further down, it will increase in speed. And that is what momentum is measuring. It will measure the speed of that move in the relative trend. And when we put that on a relative rotation graph, then the basic framework is a scatter plot. And on the horizontal axis, we've got the JDK-RS ratio. That's the red line that we just saw in the graph. And on the vertical axis, we got the JDK-RS momentum. That's the green line that we just saw in the graph. And that means that if we take all the data from all the securities in our universe, what will show up in the top right quadrant, the leading quadrant, is sectors or stocks that are in a relative uptrend versus the benchmark. And the benchmark is the center of the chart. And that trend is still being pushed higher by strong momentum. Now, I just explained that the first thing that will happen is that momentum will roll over and fade. And what then happens is that that security moves down into the weakening quadrant. It's still on the right-hand side of the graph, which means that the trend is still up. Imagine that ball going up, but at a lesser rate. That's in the lower right-hand corner. So it's still going up, but the speed is slowing down. So that's weakening. And then if that weakness continues and the ball stopped and started going down, that's where the relative trend has turned and the security moves into the lagging quadrant. And that is where you will find stocks or sectors that are in a relative downtrend, and that relative trend is still being pushed further down. Now, again, just like on the upside, the first thing that will happen is that your momentum will start to pick up, and that will push the sector into the improving quadrant, which means that it is still in a relative downtrend, but momentum is fading. And if that improvement is continuing, then you will get that rotational nature. You will get that circular movement around the benchmark. And as I said, a lot of people have been talking about sector rotation, and they use those spaghetti charts that I showed in the beginning. But when I had this on my screen the first time, and that was early 2000s, I guess, in a very, VBA, Excel, spaghetti go that didn't even look like an Rrg as we know it now. For me, being able to visualize that rotational pattern was like an aha moment, because it's like, yeah, it's actually rotating. We're talking about sector rotation, but now we can finally actually visualize that sector rotation, and it's actually rotating clockwise around a benchmark. Now, this is the Rrg for Indian sectors, and I just snapshotted that earlier today, so it's pretty actual image. And very quickly we can see that the IT index still strong. It's still the strongest in terms of RS ratio. It's the highest on the RS ratio scale, but it's losing momentum. So it had a very good run, and it's now coming down. If we look at this cluster here is banks, private banks, and financial services, and you can see that they are moving into the leading quadrant, and they're still gaining on both axes, and that's good stuff. That's what we like to see. And we also see that for real estate, and we see it for the metals sector. On the other hand, we see pharma diving into the lagging quadrant. We see media all the way down into the lagging quadrant. We see FMCG, which picked up a little bit of momentum, but now starts to move to the left again. And essentially, what in one image, I can immediately make up my mind and say, hey, that financial cluster there is pretty good. Media I should avoid, just like pharma, and maybe I need to check up on what's happening in the IT sector. Immediately, I've a grasp, a high-level idea of how these sectors are moving against each other. And this is a static picture, but we can definitely make this move. And what you will see now is this rotation playing out over 1 year of history. And you can see those trails moving through those quadrants and showing you the rotational nature of those individual sectors. You see, sometimes they can go very wide, and sometimes they stay closer. And you see the pharma index. So if you keep an eye on that pharma index, that's an interesting one because it made a very big move around. Here it comes all the way out, and now it's back down there. So you can pick up on those relative trends very easily. Now the initial rules of thumb, ever since RRGs became more popular and they became available on Bloomberg terminals, Refinitiv Icon, stock charts, which was the animated graph that we just saw, or Optima software, which is this implementation. One of the questions that I always got is, what are the rules, the buy and sell signals? And to be honest, there are no real signals. It's a chart. It's a data visualization tool. So if people ask me what are the buy and sell signals, I usually counter that by asking them, what are your buy and sell signals on a price chart? Because some people want to trade 20-day breakouts. Other people want to trade 5-day breakouts. So there's not like a one step answer to that. Now, obviously, we want to know how to interpret that. And for an RRG, I think that stuff that's in the top right-hand corner, so relative uptrend, still being pushed higher, that is what you want to hold in your portfolio. That's what's good. That's what you should hold. Now, in the weakening quadrant, that's where I either look for sells or for rebuys. Now, I need to explain the rebuys, because in an ideal world, those trails that we just saw move from leading to weakening to lagging to improving and back to leading. That's the theory. Obviously, reality, real world doesn't always follow theory. So what you will see fairly often is that in a very strong trend, securities will move from leading into weakening, back to leading, to weakening, back to leading. And you gotta visualize that as a chart of a relative strength line. And those trends are not straight lines. So they go in higher highs and higher lows. And what it means when it goes from leading to weakening and back up is that you have had that high-low rotation back to a higher high and a higher low. So especially if the securities are still very far to the right, then they are still very strong. They just go to a temporary dip. And the odds are very high that inside weakening, they will turn back up and go back to leading. For me, those are the rebuy, the re-entry possibilities. When securities come closer to crossing over to the left-hand side of the graph, that's where you want to be looking to get out of the position. That's where you are looking for sells or underweight opportunities. Now, in the lagging quadrant, that's what you want to avoid. That's what you don't want to have in your portfolio. Or if you're a very aggressive trader, that's maybe where you want to have your short positions. And in the improving quadrant, that's where you look for buys or resells. So that's basically, if you're long only, that's where your shopping list comes in. And the closer you are to crossing over, the more interesting it becomes. Or your resells, where you have that rotation back down to lagging, which is basically the reverse of a resell, just a security that's moving from lagging to improving back to lagging. If I would have to put, sorry about that. If I would have to put some sort of a, rule on that, then I would say that the crossing from left to right, so crossing 100 on the RS ratio scale, is a conservative buy or a conservative sell. That was my first idea. When I first came up with this, I thought, oh, that's easy. You buy when it moves from improving to leading, and you sell when it's moving from weakening into lagging. Truth is that you're pretty late in the game. Because of the algorithm that's behind it, and just with every algorithm, it needs a little bit of time to pick up a trend. We're trying to pick up trends in relative strength. So we do need a little bit of trend to be able to pick it up. When you move from left to right, that trend is underway. And it also means that the price development is already well underway. So then I thought, okay, now maybe we need to look for moves from lagging into improving, and we need to get out from leading into weakening. And that's what I call an aggressive buy or an aggressive sell. And the truth is, and I just explained the rebuys and the resells, when you would use that with securities that are far on the right, so very high on the RS ratio scale, you would be getting out of a trend in a very early moment. Well, there is more to come. Reversely, on the left-hand side, where you have an aggressive buy, you might be getting in too early because there is much more downside to come. So the truth is probably somewhere in the middle. And it also depends a lot on how aggressive you are as an investor or as a portfolio manager. Best way to compare it, just like we did with the Rrg, like, some people like to trade 5-day breakouts, others like to trade 50-day breakouts. Here, if you would compare it with, say, a moving average, then the aggressive would be a crossing of the 5-day moving average, and conservative would be crossings of a 50-day moving average. Obviously, the 50-day moving average gives you a much more secure and established trend than the 5-day moving average, but you'll be in much earlier, but also be prone to much more false signals, and you need to get out. So it totally needs to fit your trading style, so to say. One of the things that we learned while using Rrg is that one way to analyze this is using like a compass type analysis. And we all know a compass, 0 or 360 degrees at the top, 90 is due east, 180 degrees is due south, and 270 is due west. And with this compass, we can actually say a lot and indicate a lot of what's happening with those tails on the Rrg. And we have a lot of derived indicators, as we call them, using this type of technology. But there is one that I want to share with you on this occasion, mainly because of time. And that is what we call Rrg Heading. And the Rrg Heading, you position the compass on the previous observation, and you look at where that arrow is pointing. And in that case, that is now something like 60 degrees. And what we have found out is all the tails that are pointing in a 0 to 90 degree angle, which means that they are gaining on both axes, that is good. That means that it is strengthening. And that does not necessarily have to happen only in the leading quadrant. It can actually happen in any quadrant, which will give you a unique opportunity. It's an indication that you can only get from an RRG because it can happen anywhere. So if you would put the two RRG lines on that chart, it would be very hard to spot when it moves into that 0 to 90 degree heading. So that's one thing. If you start working with RRGs and start looking at them, the quadrants, as I just explained them, and the heading are important tools that you need to have in the back of your mind when you're analyzing markets using this tool. Now, finishing it off and bringing things together into a portfolio, I said I like to come at it from a high level. And for me, the first thing as an investor that you need to do is you need to decide on your asset classes. And this is a framework that I use in my weekly show on Stock Chart Sector Spotlight, where I analyze from time to time asset classes. And I've got real estate, government bonds, high yield, stock markets, INR, which is like a cash position. For me, that's also an asset class, commodities and corporate bonds. So I create an RRG that brings indexes that represent those asset classes on an RRG, make up my mind about where I want to be invested, stocks, bonds, and how much. So if so I want you to think in terms of your portfolio or your investment portfolio. The first thing you need to do, how much money I'm gonna, and you can use an RRG to make up your mind. So you can find which asset classes are interesting enough to invest in, or overweight if your portfolio is really big. Now, the next level would be, for example, in government bonds, you can buy short-dated government bonds or long-dated government bonds. So what I then do is I take indexes that represent various maturities on the yield curve on an RRG and look at which segments are interesting enough. Do I need to be on the longer end of the curve, or do I need to be on the shorter end of the curve? So my fixed income, my government bond portfolio can then be narrowed down to various segments on the curve. If you, for example, have an allocation to commodities, you could decide on various subgroups: energy, agriculture, industrials, live, precious metals, livestock, and industrial metals. You can create an RRG that just lists those subgroups on an RRG versus a commodity index and decide about which groups you feel are interesting enough for your portfolio. And then stocks, I'm going to assume that a lot of people here are interested in the stock market because it's very popular. You could look at the Nifty 500 in an international context. You could create an RRG that puts the S&P 500, the Nifty 500, the Stock 600, the Nikkei index, the Australian ASX, a lot of world indexes on an RRG versus, let's say, the MSCI World, and figure out which markets are interesting to invest in. Say you like the Nifty 500, from there on down, you could go into the individual sectors and you could look at the Nifty 500 through an RRG lens, bringing up, and we saw that RRG earlier, where you have an RRG showing the sectors of the Nifty against the Nifty 500, and you can make up your mind about which sectors you want to invest in. And then you can take it even one step lower. You could create an RRG for every sector, showing individual stocks in that sector versus the sector index. So you have a complete layered overview that you can actually run through various RRGs to make up your mind. And I call this my decision tree, my investment portfolio decision tree. I can do this all with RRGs at various levels. So you start with asset classes, then you go, for example, in government bonds, you can go in parts of the yield curve. In stocks, you can go international markets. Or if you don't want to invest internationally, you can just go straight into the Nifty 500 because that's your stock market. If you want to do commodities, you can do all that. You can make this as crazy as you want. And then if you're in the stock market, obviously, you can go into various sectors. And this is where actually sector rotation is going on. That's where it all started with. But once we had this visualization tool, we could apply it to, you can even apply it to currencies, believe it or not. You can look at the various currencies in the world and base it to one base currency and see which currencies are outperforming another, and make up your mind for some currency trading. So you can use this tool and this visualization to bring it all the way down to individual stocks, which would then ultimately be your portfolio. And we're 5 minutes over time, so I hope people will forgive me. If you want to contact me, then that's all fine. My mailbox is open. I have no problem discussing things. And we're going to play one little video, and after that, we'll open it up for questions.
Thank you, Julius. It was actually very interesting, because how you made those spaghetti charts, trust me, when we do all that, it makes make our life actually difficult. But the way you have presented how these graphs can be put on single screen, and the way you also showed those blue charts, and actually made it very interesting and more or less very easy for us to understand. So although it's a small time for us, maybe just half an hour to understand, but I think it's important for us to dig more and try to understand how it actually works. But the best part is in the end, when you showed us that it can be used by every analyst. So it's not only the stock, but the other asset classes also. One thing I liked the most was where you showed us the charts. So we do Indian market as a fundamental guy. We see which are the companies which are doing well. What they were actually on the right top on the index on the chart, and the companies which are not doing well, they were actually on the left bottom. So that tells us how beautiful it is working for you and for us eventually. So that's very interesting. Now I'll just go on to the question and answer session, because I have got few questions. Now, based on the RRG, now we have found that we can actually know what is the lead indicators or the lagging ones, or which is the good ones. But is it possible that, let's talk a stock like XYZ, it's on the right top of the market, right? Now, it is possible that it will stay there, right? But it can enter in the consolidation phase. Maybe on the screen, it will look the most good stock, or we'll be saying it will be holding stock, but it will not make money. Is it possible that will happen, and what to do in those cases, and how to actually know the journey of those stock if possible?
So let me get this clear. So what you mean is a stock that's been doing really well and then moves into the consolidation phase, so starts to move flat.
Yeah.
And whether that will show up on an RRG.
Yes.
Well, it depends on what the market in general is doing. So in your case, what the Nifty 500 is doing. If that stock is doing really well and it starts to consolidate sideways on the price chart, but when the Nifty 500 is falling, that stock, which is flat, will actually be outperforming the Nifty 500.
Right.
So it will remain inside the leading quadrant. If that stock moves sideways, but the Nifty continues to rise, then that stock will drop into weakening, because it now starts to underperform, despite the fact that it is not losing money in absolute terms. So in price terms, there's nothing wrong with that stock. It's just consolidating. But it will move into weakening on the RRG, because other parts of the stock market are moving higher. But that's the crucial element of RRG, that it is all relative. It's the classical story. If a fund manager, your job is to beat the Nifty 500, and the market goes down 10%, this guy goes down 5%, so he lost 5% of your money. But he's still a hero because he beat the market by 5%. And that's what you need to have in your mind. It's all relative. And, if you could choose between losing 5% to 10%, the guy that loses only 5 is still good. And that will show up. So even if the market goes down, there will still be stocks and sectors that will show up in the leading quadrant simply because they are going down less fast than the market.
Interesting. Uh, just one more question on similar lines. Through this RRG model, is it possible for us to find the lead or the lag indicators in the sector? So I'll not get into the stocks right now. Is it possible for us to get into lead or lag indicators of the segments or maybe economy? And is it possible for us to compare the US and Indian markets? Like, I'll just give a classic example. Generally, we have seen uh, a lot of EMs actually replicate what happens in the US market. So let's say when your auto starts moving up, that eventually happens in India maybe after a lag of a month or maybe 2 months. Similarly, financials, or a lot of time maybe they're in tandem. So is it possible for us to actually correlate these and maybe we can find some lead or lag indicators based on this model?
Not sure about about lead lag indicators because the visualization is the same and the building blocks will be the same. But what you just mentioned is very interesting because what you could do, or what I would do, is actually bring up two RRGs side by side, one showing the US sectors and one showing the Indian sectors, and see if I can find a relationship. You said automobiles, when they start to move in the US, then generally India follows, 1-2 months later. So if you keep those two RRGs next to each other and you monitor what's happening in the US and you find a relationship delayed with what's happening in India, you could potentially benefit from that.
Right. And just a question for you, because you have been using this since ages. What is the best time frame it has worked well? So is it a short term or long term or maybe even more? Because just the way you gave an example, like there are a lot of chartists who would say only I just want to do intraday, maybe a 1 or 2 day trade. They will just look at 3 day chart or maybe 5 day chart. But there are chartists who will say I don't understand these smaller charts. I want to do a longer one because that's how their expertise is. Now for RRG, since you're the creator, what is the time frame it works well?
Well, I mean, again, for a data visualization tool, so the data visualization works in all time frames. Weekly, daily, but you can also go into hourly. I have a number of currency traders who have an RRG of a currency universe that updates every minute or every 5 minutes. So you can actually see the rotations going on during the day. And while I was developing this, I worked on a trading floor where we had market makers who needed to make a market in, this was an investment bank that was specializing in REITs, in real estate stocks. So these guys typically would make a market, I don't know, 10, 15 names. That was their book. And they needed to continuously issue bid and offer pricing for those stocks. So, what would typically happen is that they would have a series position in maybe 3 or 4 names, because that's what you can sort of, mentally grasp while you're trading. And they would have, quotes out for the rest of their book because, nothing was happening or they weren't interested or whatever. And I then created an RRG that would update every 10 minutes during the day. And it would give them a visual tool to see if some name, because we saw the RRGs and sometimes you see something flying out to the right or to the left, and that's basically where there is something going on there. We don't know what, but there is something going on. And that RRG gave them a tool to hey, I need to check because for some reason that one starts to move. So I need to check on that stock, and I go into the graph or find the news or call my counterparts or what's happening. So the data visualization works on any time frame. What I have found for myself, but that is very personal, and the way my investments and my clients work, they're a little bit more longer term. So I prefer the weekly time frame.
Okay.
And what I always give them as sort of a guidance, rule of thumb, that the trends that you pick up are usually 3 to 6 months, but very often much longer. I've seen these relative trends go for like 18 months. Best example that I can give you on top of my head is in the US market. Look at the technology sector. Yeah. That's been in an uptrend for, I don't know, I didn't even remember when it was underperforming. Same on the left-hand side, the energy sector in the US. I think it moved to the left-hand side of the graph somewhere in 2017 or 2018, and it's been rotating on the left continuously. So those relative trends, they can really be sticky. So, for the weekly time frame, I always tell them, 3 to 6 months, often much longer. And you can translate that to, if you do daily graphs, it probably becomes like 3 weeks, something like that. And then you can make that more granular when you go to hourly and stuff like that. It depends on your time frame.
Sure. And generally, RRG is based on price action, right? Is it possible to check the volume also? Because see, generally, when you look at the charts, you say the price is moving up, but then you check the strength based on volumes and everything. Through this RRG, is it possible for us to do that also?
Yes, not with all implementations. We're continuously developing and innovating. And one of the innovations that we've been working on together with Optima is that where originally we had the little dots on the tails are the price point, the daily or the weekly, observations. But they're all the same. So what we now have done is change or give the user the possibility to change those dots into bubbles. And that bubble can be anything you like. We very often use it to show the weight of a sector in the benchmark. So you would get, the heavyweight sectors will get a big bubble, and the small weight sectors, the lightweight sectors will get a small bubble. But you could script it that the bubble size is dictated by the volume. And then you could see, and then I would need to look at it, but I think I would go for some sort of a moving average, because volume can jump up and down. So I'd probably take like a 5-day moving average, and you can see volume picking up or going out together with the tail. So the bubble would then represent the volume that is backing that move.
Sure. So one thing is there. What you showed us in the chart of the rotating one, the going from one quadrant to another, is it possible for us that it is on the right top corner and suddenly move to the left corner? And how do we interpret it beforehand? Because see, when it goes from on the right top to bottom left, we would see after when it go there. But is it possible for us to interpret it before that, how the action can be?
Well, I mean, I wish I had that answer. I mean, I think that's because that would mean that you could be looking into the future.
Yeah.
I even can't do that. But generally, the rotation is clockwise. So it gives you a little bit of an idea of where it is going. And although it's not like giving you 100% guarantee, but when you see that moving, and remember that compass with the degrees. So if something is inside leading and it starts to roll over and head, say, between 180 and 270, so that's opposite. For me, that would be a reason to check up on that graph and that trend and see if things are still good. By the way, I always tell people that I don't think Rrg is a standalone tool.
Yep.
I don't believe in standalone tools. The financial markets are a puzzle, and for us as fund managers and analysts and investors, we need to piece together all the pieces of the puzzle every day or every week. And Rrg is one piece of the puzzle. It pretty much gives you the picture of where you need to shift all your individual pieces. And that is how I see it. So when you see something on the Rrg, then I invite everybody to go to a chart. If they're Elliott wave analysts, make your Elliott wave count. If you look for price patterns, check your price patterns. If you're a fundamental analyst, go check up on your fundamentals. I mean, there are many ways that lead to room, and many pieces of the puzzle that we need to be aware of.
No, I must say it's a great tool to start with, because generally you'll find people, when you are doing a technical analysis or fundamental analysis, I would always say that doing analysis is the simplest part, but what to analyze, that's the most difficult part. But from RRG, trust me, we can at least get a starting point that you should look at these sectors, and then we can find out companies and work on it. But getting the starting point is most important, and I think this will help us a lot in that. Now, from the concepts, now let me get to the live market and ask you few questions based on that. Now, if you see generally when the market tops or bottoms, the general trend is generally 90% of stocks or maybe sectors actually will give you strong momentum. So maybe he will be on the right hand side of the corner. So what is your view currently based on, if you look at the quadrant of Indian sectors, what is your thoughts or in terms of sectors, if I may ask you about the current market?
I think I already gave that in the talk when we looked at the RRG with the sectors. Yeah. So I need to go back in my memory, because I'm not looking at Indian markets I do look at them, and not every day or every week. But that cluster of financials, so financial services, banks, private banks, those sectors, they look really nice and they look really strong. The metals, they have actually, so the cluster of financials are moving from improving into leading, so that is good. They're actually sort of reversing their downtrend back up. And then I think it was the metal sector that had a good stint. Yeah. And they rotated from weakening back into leading. So they're actually starting their second leg of their trend. So that's probably more reliable. And then we had IT, which is, had a very nice run, yeah, and is now inside weakening. And I would monitor that. It's still good in terms of relative strength, but I would monitor it because it looks as if it's on crossroads. It's either gonna curl back up and back into leading and take back its leading position, or it will deteriorate more and move into the lagging quadrant. So IT is one that I would put into my workflow, see what I can find on the price chart. Is it breaking down, or do we see crossovers of moving averages? All that kind of stuff. And then what you should avoid, I think it was media in the lagging quadrant.
The left bottom there was media.
Yeah, and also fast-moving consumer goods. So FMCG was also, it picked up a little bit and then moved left. And maybe add to that, because sometimes you say, oh, it rotates clockwise, but sometimes you see these moves where it moves up and then it moves it seems as if it's moving counterclockwise. So the chart that we were looking at was a weekly RRG. If we would load those sectors onto a daily RRG, you would see that little hook to the left on the daily RRG actually has a perfect rotation through all quadrants. The weekly RRG is just not granular enough to pick up that move back. But if you would zoom in to the daily, you would see that it would actually be a clockwise rotation, eventually moving back to the left.
Yeah. So yes, so Julius, you have made this very simple for us in terms of RRG, but I know how difficult it would be to interpret even that. I'll just give you an analogy with the fundamental analysis we do. So with the four quadrants, when you talk about, we also have made the fourth quadrant. In the right top is basically my true multi-baggers. On the left bottom is the wealth destroyers. On the right bottom is quality traps. On the left top is the growth trap. So there are two traps, one wealth creator and one destroyer. Trust me, for a fundamental analyst also, it's very difficult to understand how these companies will rotate, because you will find something very interesting. Maybe you will find the growth will come in. These are the true multi-baggers, but ultimately they will be a value traps or maybe a growth traps. So the same thing happens, and we also find it very difficult to, although the chart looks very simple. So just one advice from you, how should you actually kind of interpret these charts, because it looks very simple. On the right top, this is the sector that you should look at, and on the left bottom, this is the sector you should completely avoid. But the most important part is the left top or the right bottom. These are the one where we should work completely and then take a second step, or maybe either fundamentally or the way you say that, maybe Iliad or second level of charts, and then we can get the real answers. I think that is what you're trying to say, and that is what the investors and the we should learn from this, Rrg.
Yes, definitely. If you see that that fundamental, basically SWOT analysis is what it is, then I would pick that. I would pick the take one of the quadrants, pick the stocks or the sectors that are in one of your fundamental quadrants, and plot that on an Rrg, and see where it aligns and where it differentiates. And where it aligns, that's easy, because then the technical and the fundamentals are telling the same story. Where they don't agree, that's where we need to work. That's where either the fundamentals or so that's where you need to figure out what is leading. Has the market already picked up something that fundamentally is not priced in yet, or is the Rrg just too or the technical, is the market too enthusiastic about something that fundamentals that are not priced in yet? So I always like to find things that are not aligning, because they are telling you a story. If everything aligns, then everybody knows it.
Yeah.
You need to look for stuff that is sort of out of the box, out of what everybody knows. And that's where interesting opportunities come from.
Right. And so I think this is the what we have said, I think, is enough. I just have last final question. What are your views globally? Because right now there's so much of euphoria across the world. I don't think so in March anybody would have thought that markets across the world will be at 52-week high, be it US, be it India, be it European markets, most of them. What is that you are thinking about from here? And maybe what is the Rrg saying? Because I don't know, because Rrg is more about sectors, and does the Rrg also talks about different countries which is looking stronger? And overall, what is the market view that you can just guide us in terms of the euphoria that we see right now?
Well, I think markets in general, if you just look at the charts of all markets without knowing COVID, all the stuff that's going on in the world, a lot of markets are trading at new highs. So these markets are in uptrends. There's nothing we can do. Maybe we don't agree with it, but the market is doing it anyhow, and so that's what we have to deal with. So I do see more strength for markets in the relationship between stocks and bonds. It's primarily US based, but I believe that is sort of a global thing that's going on. You see that bond markets are topping out. It looks as if we're moving to higher yields. If you look at the US yield curve, that's been steepening for quite a while. So that means higher yields, lower bond prices. That speaks in favor of stocks over bonds. So investors will favor stocks over bonds. Now, what I think, but this is a personal opinion, and it's more like trying to make sense of everything that we see, is that the sectors that are driving those markets higher will be the markets will not be driven higher by very broad support. It will be you got to be very selective. I think as an investor, you got to be much more selective going forward, because there will be sectors that are benefiting tremendously, but there are also sectors that are just getting hammered because of everything that's happening. Eventually, market goes higher, but you got to be more selective than maybe in the past few years.
So that was very interesting, Julius. Yeah, the right answer what you made is actually we have to be selective in markets, be on the sectors also. That we have been seeing from the last 2-3 years, at least in India, that maybe the top 10 or 12 Nifty stocks are doing the major portion of earning increase or the stock market price increase. Similarly is happening in US also. When we look at the Dow Jones, the top 10 companies are maybe 60% of the rally at least.
Yep.
So with this, I would like to end the session, and I would just like to say thanks, Julius, for coming. It was very, very informative. Trust me, the biggest dilemma right now for every fund manager or somebody managing his own portfolio is how to generate alpha, which sector to be part of, and where to invest. And the second level is which sectors to be, which stocks to buy. I'll give you an example. Like, I know if I just look at a sector, I'll give a live example. If I look at the data of last 3 years, let's say auto would be up maybe 3x, Nifty up 2%, 2x, but there are stocks which will be up 20x, 10x in that time frame. So we need to get to those stocks actually which will be at 20x rather getting you 3 or 4x stocks. That is how we will generate alpha. And I think you have put it very beautifully and very simply, rather, how to basically get those scattered chart, or maybe the spaghetti chart, the new name that you've given me today, to actually put it on just one block, and so that you can do further research on that. With that, I'll just say thank you once again, and with the closing comment, we'll close the session.
Thank you.